Pada pasar keuangan, kami telah terhubung bersama dengan Chairman and Managing Member Great Hill Capital, Thomas J. Hayes dari New York. Selamat sore waktu Indonesia. Good evening, Hayes.
Hi, Andy. Nice to be with you, Andy. Thank you.
Nice to meet you again virtually. All eyes on U.S. rate inflation. So how do you project inflation in the U.S. based on your perspective? Do you think it will be remaining a downtrend?
Yes, I do. The consensus for headline inflation is 0.2% month on month, and year on year is 2.9%. Core inflation's looking at 3.8 and month on month 0.3%. However, I think we're going to set the stage for a positive surprise, meaning inflation will come in lower than expected this morning. And the reason we believe that is last month was an exceptionally low base, so that's why we moved up a little bit. This month, the base is higher for inflation. It sets the stage as we move from goods disinflation to services disinflation. I think we're going to see more weakness in services. That headline number could, in fact, come in lower than the consensus of 2.9%, setting the stage for a positive surprise. And if you look at 10-year yields at 4.2%, whereas last month we came into the print at 4.0%, I think it does set the stage for a positive surprise with lower than expected inflation numbers today.
But do you think still far gradually to reach the target 2% in terms of the U.S. markets, and also the employees still strong?
Yeah, I do think that we are going to move towards that. By our calculations, we could see headline inflation numbers below 2.4% by March, before the March meeting. And that will be a tricky situation for the Fed because, on the one hand, Jay Powell has said if we wait until it actually hits 2%, it will be too late. So if they see that services inflation starting to come down over the next 2 months, I think the surprise may be, in fact, there is a possibility of them cutting in March, and no one's positioned for that. Keep in mind, forward guidance is all they have as a policy tool. So right now, forward inflation, 5-year inflation break-evens are at 2.28%, very close to the Fed's target. What you will find with the Fed is they will continue to talk hawkish until the day that they cut. There will be no warning, Andy. They will not say, in about 3 weeks, I think we could probably cut. We're getting close enough to the target.
But previously, the Fed signaling will cut rate start in the second term in this year.
I think they could do their first cut as soon as March, even though consensus is closer to June. I think the numbers that we're going to start to see today, next month, and in March, March in particular, that they're coming close to the target. And that will give them a kind of a coin flip in March. If not March, May or June for sure will be the first cut based on the numbers we're looking at.
Mm-hmm. But how do you think about the U.S. employees rate? It's still hard to tame as U.S. rate is not to cut rate in this first term.
Yeah, in terms of the unemployment rate, it's still very low. But what we're seeing is inflation can continue to come down even in the face of good employment numbers. Inflation has steadily dropped. It's going to continue to steadily drop. And the secret here, Andy, is going to be services inflation, which have been sticky, starting to come down this month. And when we see that today and in the next month's report, that's going to put more and more pressure on the Fed to cut sooner than everyone is now anticipating. And I think expectations are very, very low for a cut in March that I think is more than a coin flip at this point.
All right. The Fed probably won't cut rates in March. So how would it impact the bond market?
Well, that is the market consensus that they won't cut in March. I think that the positive surprise could be that that becomes a possibility. In terms of bond markets today, going into this cut, as I said, last month, 10-year yield was at 4%. Now it's at 4.2%. So expectations are very, very low in terms of inflation getting a lot better in time for the March cut, I think we're going to see some data today that shows us that inflation is falling a little bit faster than expected, in which case you could see bonds start to get bid and yields start to compress because no one's really positioned for the possibility of a March cut. So keep in mind, if those inflation numbers come in softer, less inflation than expected, you're going to see a bid in bonds and a compression in yields with people starting to think maybe, in fact, the Fed could cut in March or May, despite the fact they're saying that they're not. If the numbers continue to come in better than anticipated, they will have to move sooner than June.
Okay. If the Fed maintains a hawkish stance, how much do you think the Fed will cut rate in this year?
Well, I think that the data is going to alleviate that hawkish stance a bit as the months roll on. The market has come down from 6 cuts expectation this year to 5 cuts, and that's largely due to concerted effort by the Fed to talk down markets and to imply that they're only going to do 2 or 3 cuts this year. I think it's somewhere in the middle. The earlier they start, Andy, like for instance, if they started in March or May, then I think the Fed's estimate of 2 or 3 cuts is closer to reality. The longer they wait, the more they have to do, because disinflation or deflation is a much harder problem to solve than inflation. Inflation is easy. You can just re-raise rates. Deflation is a spiral that can cost a lot of money. So the earlier they start with the first cut, the less they'll have to do. So I would say it's probably a little more than the Fed expects of 2 to 3, and a little less than the market expects. So my bet is 3 to 4 cuts for the year should be enough if they start early.
Okay, so there will be around 3 to 4 times that the Fed will cut the interest rates. So if the Fed will start cut rate in the second terms, how do you perceive it will be impact on the financial market, especially emerging markets like Indonesia?
Yeah, well, I think that the stage is set very, very favorably. As you know, for the last year and a half or so, we've been very bullish on emerging markets, and that's proved to be accurate with the exception of China. I think prospectively, emerging markets will continue to perform very well, and that's largely due as the Fed begins to cut rates. We're going to see a continuation in the weakening dollar. And as the dollar weakens historically, that's been very, very positive for emerging markets equities. I think the addition to support emerging markets equities and economy is this time around, China will start to participate economically, which will add an additional booster to the emerging markets economies and the global economy as they've come out of COVID over the last year and a half, and their economy starts to hit on all cylinders. We remain extremely constructive despite the positive move you've had in Indonesian markets. We remain continually constructive for the next 3+ years on emerging markets as the Fed starts to cut and as the dollar continues to weaken.
All right. How do you recommend investors positions their portfolios given this backdrop of higher for longer rates?
Well, what we have seen is that markets perform well in terms of getting a little allocation into emerging markets, number one, as the dollar weakens. And as far as the U.S., our markets have gotten a little bit overvalued. We've been up 14 out of the last 15 weeks. So I think where the relative value is not in the large cap stocks that have driven the rally of late, but actually in the small and mid cap stocks, which are trading at a much lower multiple. So while the general indices trade at about 20 times forward earnings, the small and mid caps trade between 14 to 16 times earnings. And I think that's where you're going to get your relative value, both in emerging markets as the dollar weakens and the Fed starts to ease, and in the U.S., small and mid caps, which are trading at a lower valuation than the general indices, or the aggregate, what we call the Magnificent Seven, the big tech stocks, the AI stocks, are trading a little bit rich, and I think they have to take a breather. So in the next 2 months, at some point after moving up, 14 out of 15 weeks, the markets will probably start to pause in general for a little bit catch their breath. But when you look at election years since 1928 in the US, the average returns for the general indices are up 11.28%. So even if we do rest, I do think we're in for a pretty good year in equities in the US, and I think emerging markets may even prove to outperform the US.